Welcome back to the Daily Crypto Roundup, where we cut through the noise and bring you the real pulse of the market. Today we've got a packed show, from Revolut securing a major crypto license in Cyprus that could reshape digital banking across Europe, to Evernorth's billion-dollar XRP treasury, shaking up institutional crypto finance, and Bitcoin pushing back above 111,000 as the Federal Reserve edges toward a rate cut. We'll also look at Crypto.com's next big leap, filing for a full U.S. national bank charter, and wrap up with what Wall Street analysts are predicting for Bitcoin and Ethereum by Christmas. Spoiler: the numbers are bold. Before we dive in, make sure you drop us a follow wherever you're listening and hit that 5-star rating. It helps the show reach more traders, investors, and crypto fans just like you. All right, let's look at the latest market prices right now. Bitcoin is sitting strong at around $111,296. Holding firm after a late-week surge that's got traders cautiously optimistic. Ethereum trades just below $4,000 at $3,961, a psychological milestone that bulls are desperate to reclaim. Binance Coin comes in around $1,127, showing solid resilience amid exchange-driven headwinds. XRP continues to hover around $2.48, boosted by institutional moves tied to Evernorth's new billion-dollar fund. Solana trades at $193.59, while Dogecoin is stable around 19 cents. Tron holds 31 cents, Cardano stays near 65 cents, Chainlink is at $17.52, and Litecoin closes the list at roughly $93.76. Across the board, the crypto market is flashing cautious strength. Global market cap has pushed back above $4.2 trillion, and total 24-hour volume is up more than 14%. A sign that money is starting to move again after last week's slowdown. Revolut's Cyprus license, a European crypto power play. Our first major story tonight: digital banking giant Revolut has just secured its long-awaited crypto license in Cyprus, officially becoming one of the first major fintechs approved under the EU's MiCA framework. This might sound bureaucratic on the surface, but it's actually huge. Revolut now has the green light to offer crypto trading, custody, and staking services across all 27 EU member states. And for context, that's access to over 450 million potential users under a unified rulebook, something that even Binance and Coinbase are still finalizing their filings for. What makes this significant is timing. Revolut's crypto arm had scaled back earlier this year after temporary suspensions in certain European regions. But now, this license repositions them as a fully compliant, cross-border exchange and custodian. Insiders say the firm plans to launch staking for Solana and Ethereum by the first quarter next year, along with retail token purchases that could rival Coinbase's European rollout. The European market has been desperate for a regulated retail on-ramp, and Revolut already has a built-in audience of 40 million users. Analysts at Bloomberg Intelligence are calling this the most significant MiCA approval so far, because it effectively gives Revolut a passport to operate everywhere from Berlin to Barcelona without relicensing. But there's a deeper layer here: traditional banking integration. Revolut can now offer seamless swaps between euro accounts and crypto holdings, and even integrate debit cards that auto-convert from assets like Bitcoin or Ethereum in real time. That blurs the line between legacy finance and crypto in a way that regulators have spent years trying to contain. If they pull it off, Revolut could quietly become Europe's largest crypto exchange by active accounts within 12 months. One analyst from Morgan Stanley put it bluntly: they've just made crypto banking mainstream in the EU. Now, let's talk about the story everyone in the XRP community is buzzing about: the institutional fund that might finally change the perception of Ripple's token. Evernorth, a New York-based digital asset management firm backed by several former Ripple executives, has announced the creation of a $1 billion on-chain treasury, built entirely on the XRP ledger. According to company filings and early press releases, Evernorth has already secured more than $261 million in XRP for its first tranche, with further capital scheduled to be deployed through 2026. Their plan is to issue institutional-grade debt instruments and liquidity products directly on the XRPL, something that, if successful, could finally push XRP into the mainstream of corporate treasury and cross-border settlement. This is a big vote of confidence for the underlying network. The XRP ledger has long been technically strong, but suffered from legal baggage tied to Ripple's past battles with the SEC. Evernorth's move signals that institutional investors are no longer afraid of that history. They're embracing the speed, the cost efficiency, and the compliance benefits of the XRPL architecture. A source close to the project described it as an ETF meets bank model, where XRP isn't treated as a speculative coin, but as a base layer for on-chain credit markets. That would make Evernorth the first US-based firm to use a crypto token as collateral for regulated treasury products. And this isn't just a Ripple story. It's a bigger story about trust returning to tokenized finance. In fact, the announcement coincided with XRP hitting $2.50, its highest level in weeks, and a 12% increase in daily volume. That's retail and institutional enthusiasm colliding at the same time. If this model works, other asset managers may follow. JP Morgan's Onyx division and Citi's DAML-based platforms are both reportedly exploring XRPL-compatible pilots for cross-chain liquidity testing. So, what's happening here is potentially historic, the beginning of institutional XRP adoption at scale. Now, let's shift to the market-wide picture. Bitcoin has managed to reclaim the $111,000 mark, climbing nearly 5% in the past 24 hours, thanks to renewed optimism around the Federal Reserve's upcoming meeting. Traders are betting heavily that the Fed will cut interest rates by 25 basis points when it meets on October 29th. That might sound small, but in crypto terms, it's seismic. Lower interest rates mean cheaper borrowing, more liquidity, and historically, a strong upward push on risk assets. And crypto tends to amplify that reaction. The latest CPI data came in softer than expected, fueling hopes that inflation is cooling faster than anticipated. Bond yields dipped, stocks rallied, and Bitcoin followed suit almost instantly. Over $780 million in shorts were liquidated in under 12 hours, driving an aggressive short squeeze that added thousands to Bitcoin's price in a matter of hours. Ethereum, Solana, and even older assets like Litecoin have also benefited from this shift in macro sentiment. Traders who had been bracing for another hawkish Fed are now looking at the possibility of 2 rate cuts before year-end, a scenario that could keep Bitcoin hovering around this range or even push it higher if demand holds steady. Analysts are split, though. Some warn that the rally could be a pre-FOMC bull trap, where optimism gets priced in too early. But others, like Fundstrat's Tom Lee, argue this is the early stage of a multi-month rotation where institutional funds move out of cash and bonds into digitally scarce assets. Lee said this week, "The liquidity setup looks eerily similar to early 2020, just before Bitcoin's last exponential leg." That's the kind of comparison that makes traders sit up. But unlike 2020, this time we're entering a lower inflation, higher regulation world. And that might make this bull run more sustainable. Let's turn to a story that sounds dry on the surface, but could completely change how US institutions touch digital assets. Crypto.com has filed for a US National Trust Bank charter. That means they're not just trying to be a crypto app with a debit card anymore. They're trying to stand shoulder to shoulder with the oldest rails in American finance, under the same roof of regulation, capital requirements, audits, and oversight. If they're approved, they won't need to piggyback on partner banks to custody or settle digital assets for US customers. They'll be able to run those services themselves, inside a federally supervised entity, with clear fiduciary obligations and a regulator in the room. Why does that matter to you? The person listening on the train, in the gym, or walking the dog? Because every time a crypto company steps closer to a bank, the friction between your dollars and your tokens goes down. For institutions, it lowers the compliance risk of holding digital assets on behalf of clients. For corporate treasurers, it makes it simpler to move working capital between cash and tokenized dollars. For you, it means fewer service unavailable messages on days when the market's moving fast and everyone's trying to wire money into an exchange at once. It also means stronger segregation of customer assets, standardized audits, and frankly, a sturdier roof over your deposits. It's easy to forget how young this industry still is. Half a decade ago, crypto platforms were fighting just to get bank accounts. Now they're applying to become banks. That arc tells you something important about where we are in the adoption curve. The UX is catching up with the excitement. When the rails feel normal, that's when the next cohort of users arrives without thinking of themselves as into crypto. They're just moving money, paying invoices, earning yield, routing cross-border settlements, and yes, occasionally punting a meme coin on Friday night. The bank charter move is about making all of that boring in the best possible way. Now let's zoom the lens out to the macro backdrop that's shaping everything from intraday volatility to end-of-year positioning. The market's consensus right now is that the Federal Reserve will cut rates by 25 basis points at the next meeting. If that happens, it's not because the Fed suddenly fell in love with risk assets. It's because the balance of risks has shifted toward keeping growth alive and preventing policy from remaining too tight for too long. For crypto, lower policy rates do three things. They cheapen leverage, they raise the appeal of risk assets relative to cash, and they keep the US dollar from running too hot, which historically correlates with stronger crypto performance. But let's not turn that into a cartoon. Rate cuts don't automatically equal vertical candles. Sometimes they're a sell the news event if the market's already run too far on expectations. Sometimes they spark rotations inside crypto rather than broad melt-ups. Capital leaves long-duration narratives and moves into cash flow stories like staking, liquid stakings with tangible usage. Sometimes they simply reduce background headwinds so that organic catalysts, like network upgrades, ETF inflows, or corporate adoption, can do their work without swimming against a riptide. What you should listen for in the Fed's messaging is the path, not the single step. Does the language suggest one cut and a long pause, or a glide path to a second cut if growth holds and inflation continues to cool? If it's the latter, the market will start discounting easier conditions into 2026, and you'll feel that tailwind beneath the majors first, Bitcoin and Ethereum, before it trickles down into the riskier ends of the spectrum. If it's the former, we may get choppy ranges and headline-driven spikes. In either scenario, positioning matters more than prediction. Today's bounce is constructive, but the options market still shows traders paying up for downside protection. That tension, optimism laced with caution, is why we keep saying this phase is about professionalism, not bravado. Now, the big one. Standard Chartered has updated its outlook on Ethereum and pinned a new year-end target toward the 7,500 mark. Not a meme, not a screenshot from a Telegram channel. An actual desk note from a major bank raising the ceiling on Ethereum based on what they're seeing in flows and on-chain activity. On the face of it, that's a big number from where we are today. The question isn't just, could it happen? It's, what would need to happen for that to be the print? Let's walk it through calmly. The bull case has three pillars. First, institutional access. Since spot Bitcoin products normalized the path for mainstream exposure, the pipeline for Ethereum exposure, whether through structured notes, trusts, or spot vehicles where allowed, has thickened. Each time a compliance department signs off on the idea that crypto can live on the same shelf as gold and treasuries, the practical friction shrinks. If more pensions and asset allocators greenlight small Ethereum sleeves, even basis point allocations compound into real dollars. Second, the on-chain economy. Ethereum's value prop isn't just scarcity, it's productive demand for block space. If activity on L2s continues to rise, think payments rails on Base, on-chain consumer apps, games and loyalty networks, tokenized treasuries, then fees and burns follow. You don't need eye-watering gas for the supply math to help. You need consistent usage that keeps net issuance subdued or negative while staking yield anchors the carry. The more boring real-world use cases that quietly plug into Ethereum's stack, the stronger that foundation gets. Third, macro. If the Fed is genuinely transitioning from restrictive to neutral, and if the dollar stops grinding higher, assets with duration, equities, long bonds, and yes, Ethereum, catch a bid. Pair that with a rotation back into growth and a second-half risk window opens, where narratives matter again. In that window, even modest ETF-like flows or treasury experiments can have outsized price impact because the float is tighter than most people think. So much ETH is staked, restaked, wrapped, or parked in cold storage that the daily liquid supply is thinner than the market cap implies. Now the bear case, or at least the keep your feet on the ground case. 7,500 requires more than vibes. It requires that the activity on L2s translate into sustainable fee throughput, and not just bursts of speculative traffic. It requires that regulatory noise stays in the background, no surprise rulings that tie exchanges in knots. It requires that Bitcoin doesn't suck all the oxygen out of the room if it rips first. Historically, when Bitcoin goes vertical, Ethereum can lag until the rotation phase kicks in. It also requires that the narrative around restaking remains a net positive, product market fit for new services without creating the kind of soft leverage that spooks risk committees. There's also the simple math of distance. From the high 3,000s to 7,500 in a few months means a market that doesn't just trend, it sprints. Can it sprint? Absolutely. Ethereum has a history of doing exactly that when liquidity, narrative, and structural tailwinds align. Does it have to? No, it doesn't. The more likely path in a neutral macro is stair steps punctuated by event-driven candles. Think bursts on regulatory clarity, L2 ecosystem announcements, or big-name corporate integrations, with pullbacks that shake out weak hands but hold key moving averages instead of collapsing. So where does that leave Standard Chartered's number? As a stretch, but not a fantasy. As a scenario that demands things go right more often than they go wrong. Crucially, as a talking point that will have traders leaning forward without necessarily levering up on day one. The smartest desks will treat it as a map, not a prophecy. Identify the signposts that would validate the path: accelerating L2 throughput, consistent net burn, fresh institutional wrappers, friendlier macro, cleaner regulatory tape, and re-rate probability each time one of those lights turns green. Let's wrap this up cleanly. Today's market got a lift because the scaffolding is firming. Revolut just turned MyCA into an actual business plan and gave Europe a compliant retail on-ramp with real scale. Evernorth showed that the XRP ledger isn't just for tribal fights on Twitter. It can host institutional-grade treasuries with grown-up controls. Bitcoin reclaimed altitude with macro at its back, not just because of noise on X. Crypto.com is chasing a bank charter, telling you the war for trust and custody is moving inside the house, not around it. And the Ethereum call from Standard Chartered is the kind of shot across the bow that makes a slow tape suddenly feel alive. That's your Daily Crypto Roundup. We'll be back tomorrow with the freshest numbers and the stories that actually matter. Stay sharp, stay safe, and we'll see you at the top.